On April 7th at 5:32 p.m., Donald Trump posted a ceasefire announcement with Iran. And within 24 hours, markets exploded higher. The S&P 500 jumped over 2.5%, the Nasdaq Composite surged nearly 3%, and the Dow Jones Industrial Average added more than 1,300 points, its strongest day in almost a year. Financial media called it a relief rally, but there's just one problem. There was no relief. Because while headlines were celebrating peace, the actual data showed chaos. Shipping through the Strait of Hormuz had collapsed by nearly 96%. Oil infrastructure risks were still active. And geopolitical tension hadn't disappeared, it had just paused. So if nothing was actually fixed, why did markets go vertical? To understand that, you have to rewind a few weeks, back to when things were quietly falling apart. By late March, the S&P 500 was down almost 9%. But that wasn't the real story. Under the surface, positioning had become dangerously one-sided. According to Goldman Sachs, hedge funds were dumping equities at the fastest pace since 2020. Gross leverage had climbed above 300%, near historical extremes. And short positions on major ETFs like SPY and QQQ were at pandemic-era highs. Translation, Wall Street wasn't just cautious, it was leaning hard in one direction.
And when everyone leans the same way in markets, it doesn't take good news to cause a rally. It just takes less bad news than expected. Then came April 8th. The market opened and everything flipped, but not because investors suddenly became optimistic, because they were forced to. This is where the real story begins. It starts with something called a short squeeze. When funds short the market, they're betting prices will fall, but if prices rise instead, losses start compounding fast. And at a certain point, brokers step in with margin calls, forcing funds to buy back shares at higher prices just to close positions. That buying pushes prices even higher, which triggers more margin calls, which triggers more buying, a feedback loop. And on April 8th, that loop ignited. But that was only the first domino, because right behind it came the machines. Systematic funds, especially CTAs, don't think, they react. When trends break certain levels, their models automatically flip positions. Before the rally, CTAs were sitting on roughly $30 billion in short exposure. Within days, they weren't just neutral, they were aggressively long.
Goldman initially estimated $40 billion in forced buying. The actual number? Closer to $86 billion in just 5 trading sessions, one of the fastest buying surges ever recorded. And then came the third layer, the options market. In 2026, this is where things get absurd. Same-day expiration options now make up over 60% of S&P trading volume. On peak days, that's more than $2 trillion in notional exposure changing hands. And every single one of those trades forces dealers to hedge. When markets rise, dealers buy more. When markets fall, they sell more. It's called gamma. And during this rally, we were deep in a negative gamma regime, meaning every move amplified itself. So now you had 3 forces hitting at once. Short covering, systematic buying, options-driven hedging. That's not a rally. That's a chain reaction. And we've seen this movie before.
In 2018, Jerome Powell said the word patient, and the Dow had one of its biggest days ever. In 2024, when the Bank of Japan tweaked policy, the Nikkei collapsed 12%, then surged 10% almost immediately. Different headlines, same mechanics. Because the structure of the market has fundamentally changed. Today, over 60% of U.S. equity funds are passive. That's more than $13 trillion blindly tracking indexes, not analyzing businesses. Meanwhile, hedge funds are more leveraged than ever, operating under strict risk limits that force instant reactions. And layered on top of all of it, an options market so large it can move the entire system intraday. The result is a market that doesn't think anymore. It reacts violently, mechanically, and often irrationally. Which brings us back to April 8th. The rally wasn't about peace. It wasn't about fundamentals. It wasn't even about confidence. It was about positioning breaking. And once it broke, everything flipped. So the next time you see markets rally during chaos, just remember, the headlines are explanations. The mechanics are reality. And in today's market, reality moves a lot faster.